The Oracle of Omaha, a timeless guide to wealth. Have you ever wondered how some people build incredible wealth in the stock market, not through wild guesses, but through a steady, understandable process? For decades, one name has stood above all others. Warren Buffett, often called the Oracle of Omaha, he is celebrated not just for his fortune, but for the transparent, principled way he built it. He didn't rely on complex algorithms or risky short-term bets. Instead, he used a philosophy called value investing, a common-sense approach. Treat buying a stock as buying a piece of an actual business. This idea made him one of the most successful investors in history. This video guide makes Buffett's methods accessible to everyone. We will walk through the book Warren Buffett, How to Invest Like Warren Buffett by Jasper Herweijer chapter by chapter. The goal is simple: break down the core principles that guided Buffett for over half a century. We will demystify value, risk, and long-term thinking. You don't need a finance degree or Wall Street background to understand these ideas. You just need a willingness to learn and a patient mindset. By the end of this journey, you'll have a clear framework to make your own investment decisions. The aim isn't to copy Buffett's stock picks blindly, it's to equip you with his mental models and analytical tools. You'll learn to think for yourself, assess businesses on their merits, and patiently wait for the right opportunities. We'll distill the complex world of finance into simple, actionable lessons. Let's begin this educational journey and unlock the secrets to long-term financial success. We begin our journey with Chapter 1, which introduces the man himself, Warren Buffett. To understand his investment philosophy, it is essential to first understand who he is and the path he took. Buffett wasn't born into Wall Street royalty. He was a driven young man from Omaha, Nebraska, with an early fascination for business and numbers. This early entrepreneurial spirit shaped his view of stocks. He didn't see them as flickering symbols on a screen. He saw them as fractional ownership in real businesses. This fundamental perspective is the cornerstone of everything he does. A pivotal moment was his time at Columbia Business School, where he studied under Benjamin Graham, the father of value investing. Graham taught him to view the market as a moody business partner, Mr. Market. Sometimes Mr. Market is euphoric and offers to sell you his shares at ridiculously high prices. Other times he is despondent and offers them at a deep discount. Graham said, a wise investor should ignore the mood swings and instead focus on the underlying value of the business. The practical takeaway from this first chapter is to start shifting your own perspective. Stop thinking about stocks as lottery tickets. Start thinking about them as businesses. Before you even consider investing a single dollar, ask yourself, is this a business I would want to own outright? Building upon the introduction to the man, the second half of Chapter 1 distills his philosophy into clear, actionable principles. These are the rules that have guided every investment decision Buffett has made. The first principle is to invest for the long term. Another is investing within your circle of competence. Discipline and patience are two other pillars. Buffett compares investing to baseball, where the key is waiting for the perfect pitch. You don't have to swing at every opportunity. Wait for the one great business at a fantastic price and then swing with conviction. This requires emotional control. Finally, think like a business owner. Buying a stock means buying part of a productive enterprise. That mindset forces the right questions. These principles transform investing from chance into a disciplined pursuit of value. Chapter 2 draws a bright, clear line in the sand, separating the world of investing from the world of speculating. This distinction is absolutely critical. The book defines investing as committing capital based on thorough analysis. An investor's profit comes from the long-term performance and the earnings of the underlying business. You are a part owner. In stark contrast, speculation is betting on short-term price changes. A speculator's profit depends on predicting the psychology of other market participants. This is a game of guessing price movements. Buffett warns that this is a dangerous game to play. While you might get lucky once or twice, it is not a sustainable strategy for building long-term wealth. It is fundamentally a zero-sum game where one person's gain is another's loss. The chapter introduces two of the most important concepts: intrinsic value and margin of safety. Intrinsic value is a business's true underlying worth, independent of its stock price. The margin of safety is the difference between that value and the price you pay. For example, if you estimate a company's value to be $100 per share but you buy it for $60, you have a $40 margin of safety. This buffer is your protection against unforeseen problems, errors in your judgment, or just plain bad luck. Chapter 3 shifts our focus from the what to the how. The book argues that the biggest enemy of the average investor is not the market but themselves. More specifically, human emotions, fear and greed. When the market is soaring, greed takes over. Conversely, when the market crashes, fear and panic set in. To succeed, you must learn to detach your emotions from your investment process. This requires being a contrarian thinker. As Buffett famously advises, you should be fearful when others are greedy and greedy only when others are fearful. It takes real courage to buy stocks when the headlines are screaming recession. This requires an extraordinary amount of patience and discipline. You might spend months or even years waiting for an opportunity. The disciplined investor does nothing, content to sit on cash and wait. Now that we have the proper mindset, we move into the analytical core of Buffett's strategy. He famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." A wonderful business is simple and understandable. It has a consistent and predictable operating history, and it has a strong and trustworthy management team. The most powerful concept is the economic moat, a sustainable competitive advantage that protects a company from rivals. This can be a strong brand, a network effect, high switching costs, or a unique cost advantage. Chapter 5 teaches you how to verify a company's quality by learning to read its financial statements. They are the report card of a business. The income statement shows a company's profit. The balance sheet is a snapshot of what it owns and owes. And the cash flow statement tracks the actual cash moving through the company. Buffett uses these to gauge business health. He looks for a high return on equity, low debt levels, and consistently high profit margins. These metrics help separate the truly wonderful businesses from the mediocre ones. Chapter 6 tackles the final analytical step: valuation. This is the process of estimating a company's intrinsic value to ensure you pay a fair price. The chapter gives a simpler Buffett-aligned method, the earnings power value. It avoids complex forecasting by focusing on current sustainable earnings. This gives a conservative baseline value. The approach is powerful because it's simple and conservative. It forces focus on proven current earnings instead of speculating on rosy future growth. It gives an analytical anchor for what a reasonable price is, preventing you from getting swept up in market euphoria and overpaying. Chapter 7 revisits the single most important concept for protecting your capital. For Buffett, risk is not volatility, it is the permanent loss of capital. The margin of safety is the practical tool that prevents this. A large discount provides a twofold benefit. First, it creates a powerful defense against loss. Second, it creates the opportunity for extraordinary returns. Chapter 8 explains Buffett's famous long-term investment horizon. Once he has bought a wonderful business at a fair price, his preferred holding period is forever. This long-term strategy allows you to fully benefit from the power of compounding, generating earnings on reinvested earnings. A great company is a compounding machine, and by holding on, you become a long-term partner in that success. So, Chapter 9 serves as a crucial warning. After learning what to do, it is equally important to know what not to do. The book outlines common mistakes, letting emotions rule, chasing hot stocks, and over-diversification. Buffett advocates for a concentrated portfolio of your 10 to 20 best ideas. We have finally arrived at the fourth and final act, which translates all the theory we have learned into a concrete action plan for beginners. Step 1. Build your circle of competence and research list. Step 2. Perform your due diligence by reading annual report. Step 3. Estimate intrinsic value and create a watch list with your buy price. Step 4. When the price hits your target, act with discipline and shift to patient monitoring. We have reached the end of our guide. Investing succeeds when it's businesslike. You are not buying a lottery ticket. You are buying a fractional ownership in a real enterprise. This framework defends you against speculation and builds long-term wealth. Your next steps begin. Start small. Build your circle of competence. Practice on paper to build discipline and keep learning. Buffett reads and thinks constantly. This guide is a beginning, not an end. Stay curious, stay disciplined, stay patient. The market will test you, but these principles will be your anchor. Embrace the owner mindset and you will be well on your way to navigating the markets, protecting your capital, and steadily compounding your wealth over time. Section 1. The Oracle of Omaha, a name synonymous with success. In the vast and often tumultuous world of finance, there are very few names that command as much universal respect and admiration as Warren Buffett. For decades, he has been a towering figure, a beacon of stability and wisdom in an industry frequently driven by fleeting trends and speculative frenzy. Known affectionately as the Oracle of Omaha, his name has become completely synonymous with investing success. He transformed a struggling textile company, Berkshire Hathaway, into a colossal conglomerate, a testament to a lifetime of disciplined decision-making. His journey is not just a story of accumulating wealth, it's a narrative that offers profound lessons on business patience and the enduring power of a sound, logical approach to the markets, making him a figure worth studying for anyone looking to secure their financial future. When we look at the list of the world's wealthiest individuals, we often see tech moguls and entrepreneurs who built empires on groundbreaking innovations. Warren Buffett stands out as a unique case. He didn't invent a revolutionary piece of technology or create a new industry from scratch. Instead, he amassed his staggering fortune primarily through the art and science of investing in other people's businesses. His genius lies in his ability to identify great companies trading at fair prices and then holding onto them for the long haul. This method, while seemingly simple on the surface, requires a deep understanding of business fundamentals, an unwavering temperament, and a commitment to core principles that have stood the test of time, weathering numerous market crashes and economic downturns. The story of Warren Buffett's success begins not in a glamorous Wall Street office, but in the heartland of America, in Omaha, Nebraska. This geographical grounding is symbolic of his entire philosophy. Stay away from the noise, the hype, and the herd mentality of the financial centers. From a young age, Buffett displayed an incredible aptitude for business and numbers, famously buying his first stock at the age of 11. He didn't rely on complex algorithms or risky derivatives. Instead, he learned from his mentor, Benjamin Graham, the father of value investing, and honed a strategy based on buying wonderful businesses at a sensible price. This grounded, business-focused mindset is the cornerstone of his legacy and the primary reason he continues to be an inspiration for millions of investors worldwide. This video essay is dedicated to demystifying the legend. We are going to delve into the core of his investment philosophy, not as a historical curiosity but as a practical guide for today's investor. The goal is to move beyond the headlines and the famous quotes to understand the actionable framework that has guided his decisions for over half a century. We will explore how he thinks, how he analyzes companies, and how he has consistently managed to outperform the market without taking on excessive risk. By the end of our journey, you will have a clear understanding of the principles that made Warren Buffett one of the most successful investors in history, and you'll be equipped to start applying them to your own financial life. 2. Why Buffett's wisdom endures: the philosophy of long-term value. So, what is the secret behind Warren Buffett's incredible and sustained success? Why does his strategy continue to work decade after decade? The answer is surprisingly simple yet profoundly powerful. Buffett doesn't see stocks as flickering tickers, he sees them as fractional ownership in real businesses. This shift in perspective unlocks his approach. Think like a business owner, not a trader. You start caring about long-term competitive advantages, the quality of management, consistent profits over many years. This mindset makes his strategy resilient. Markets are volatile short-term, driven by news headlines, investor sentiment, macroeconomic fears. For Buffett, that noise is irrelevant. Over 5 years, 10 years, 20 years, the market price of a stock will ultimately reflect the underlying performance of the business itself. Great companies that grow earnings deliver great returns. Patience lets him ride out storms and benefit from business growth. Discipline and emotional control are critical. Be fearful when others are greedy. Be greedy when others are fearful. It takes psychological fortitude to buy in panic. It takes restraint to avoid bubbles during euphoria. His strategy is rooted in logic, analysis, and strict criteria. He waits for wonderful businesses at attractive prices and acts decisively for the long term. That discipline avoids common investor mistakes. The philosophy is timeless because it rests on business fundamentals. Technology will change, consumer tastes will evolve, economies will cycle through booms and busts. But great business traits, a strong competitive advantage, honest and able management, a durable product or service, will always drive long-term value. It's not about timing or hot stocks, it's about identifying and partnering with excellent companies. That's why his wisdom remains relevant today and for generations to come, providing a clear path through the complexities of the financial world. Section 3. Your Guide to the Buffett Way. What this book will teach you. While the principles behind Buffett's success are timeless, understanding how to apply them can feel intimidating, especially for a beginner. This is where books like Richard Burrow's Warren Buffett, The Ultimate Guide to Investing, like Warren Buffett, become so valuable. They act as a bridge, translating the high-level philosophy of a master investor into a structured, understandable, actionable framework. The primary goal of the book, and by extension this video, is to demystify the Buffett methodology. We aim to break down his core tenets into simple, digestible concepts that you can begin to use in your own investing journey, regardless of your current level of experience. This isn't about blind imitation, it's about learning the fundamental principles of sound investing from the very best. Throughout this video, we will be using the book as our guide to unpack the key pillars of the Buffett way. We'll start with the basics, exploring his mindset and the foundational rules that govern every investment he makes. You'll learn why he emphasizes buying businesses, not stocks, and what it truly means to have a circle of competence. We will explore the critical importance of patience, not just as a virtue but as a strategic tool that allows the magic of compounding to work in your favor. The objective is to equip you with a new lens through which to view the stock market, one that prioritizes long-term ownership and business quality over short-term speculation and market noise. Beyond the philosophical groundwork, this guide will get into the practical, hands-on aspects of Buffett-style investing. We will walk through the process of how to analyze a company from the ground up. This includes learning how to identify businesses with durable competitive advantages or economic moats that protect them from competition. We'll also touch upon the importance of evaluating a company's leadership team, as Buffett believes that honest and capable management is a crucial ingredient for long-term success. The book provides a clear blueprint for finding these high-quality companies, and we will illustrate this concept with real-world examples to make them tangible and easy to grasp, moving you from theory to practical application. Finally, and perhaps most importantly, this guide will teach you about the crucial concept of valuation and the margin of safety. It's not enough to find a great company. A successful investment requires buying that company at a sensible price. We will break down the basics of reading financial statements, the income statement, balance sheet, and cash flow statement to understand a company's true financial health. From there, we will explore simplified methods for estimating a company's intrinsic value and learn why Buffett insists on buying at a significant discount to that value. This margin of safety is the ultimate defense against error and bad luck, forming the bedrock of his strategy for capital preservation and risk management. Section 4. Our journey through the book, a chapter-by-chapter roadmap. To ensure this learning journey is as clear and structured as possible, we will follow the book's layout, dedicating a segment of our video to each of its core chapters. This chapter-by-chapter approach will allow us to build your knowledge systematically, starting with the foundational concepts and progressively moving toward more advanced practical applications. Think of it as an educational roadmap, guiding you step by step through the entire landscape of Warren Buffett's investment world. Each section will be clearly marked so you can easily follow along or revisit specific topics later. Our path is designed to be beginner-friendly, ensuring that complex ideas are explained in a simple and accessible manner, without sacrificing depth or detail. We will begin our exploration with Chapter 1, which introduces the man himself, who is Warren Buffett. Here, we'll trace his remarkable life story, from his early entrepreneurial ventures as a boy to his transformation of Berkshire Hathaway into a global powerhouse. Next, in Chapter 2, we will dive into the core principles of the Warren Buffett way, establishing the foundational rules that govern his entire philosophy, such as thinking like a business owner and staying within your circle of competence. Chapter 3 will then help us understand value investing, defining what it means and how it differs from mere speculation, introducing the critical concepts of intrinsic value and margin of safety that we will build upon throughout the video. Chapter 4 will reveal the Warren Buffett portfolio strategy, explaining how he constructs his concentrated portfolio of high-quality businesses. Then in Chapter 5, we'll learn how to find great businesses by looking for key characteristics like economic moat, strong brands, capable management. To do this effectively, we need to understand the numbers. So Chapter 6 will make financial statements simple, breaking down the income statement, balance sheet, and cash flow statement. Building on that, Chapter 7 will show us how to value a company the Buffett way, offering a simplified framework for estimating a business's intrinsic worth. This sequence is designed to give you a complete toolkit for company analysis. Finally, we will conclude our journey with the chapters that solidify the long-term mindset. Chapter 8 revisits risk margin of safety capital preservation, reinforcing why Buffett's #1 rule is to never lose money. Chapter 9 will illuminate the incredible power of long-term holding and compounding, showing how patience creates extraordinary wealth over time. In Chapter 10, we'll learn from the mistakes of others by covering common investor mistakes to avoid. And to bring it all together, Chapter 11 provides a beginner's roadmap on how you can start investing like Buffett today. By the end of this comprehensive overview, you will not only have read the book vicariously through this video, but you will also have a solid foundation to begin your own journey as a disciplined, value-oriented investor. Section 1. The Boy from Omaha: Buffett's Early Life and First Investments. To truly understand the investment philosophy of Warren Buffett, we must first journey back to his origins in Omaha, Nebraska. His story is not one of inherited wealth or Wall Street privilege. It is a testament to an early and profound fascination with business and numbers. Born in 1930 in the midst of the Great Depression, young Warren was shaped by financial prudence and hard work. His father, Howard Buffett, was a stockbroker and later is a U.S. congressman, exposing Warren to finance early. He was an active, curious participant, devouring every investing book he could find in his father's office. Buffett's entrepreneurial spirit ignited long before his first stock. He was constantly seeking ways to earn and save money, selling chewing gum, Coca-Cola door-to-door, delivering newspapers. He demonstrated an innate understanding of profit margins and customer service. He placed a pinball machine in a local barbershop. He reinvested the profits to buy more machines and expanded locations. He learned about passive income and assets that generate cash flow. At 11, he formally entered the stock market. He and his sister Doris pooled money to buy 3 shares of City Service Preferred at about $38 per share. The stock dropped to $27, a painful lesson. He held, it rebounded to $40 and he sold for a small profit. Later, it soared past $200, a source of regret. He learned 3 lessons. Don't fixate on the daily price. Be patient with good investments. Don't rush to sell a quality asset for a small gain. These years forged his character and core ideas. His hands-on ventures taught him how companies work. They're more than textbooks. Newspaper routes taught recurring revenue and subscription models. Pinball machines taught capital allocation and scaling. This foundation set him apart from other investors. He learned to think like a business owner first, a stock picker second, long-term value. Hello and welcome. Today, we're diving into the mind of a true investing legend. His name is Warren Buffett. You've probably heard of him. He's often called the Oracle of Omaha for his incredible wisdom and foresight. For decades, he has stood as one of the wealthiest and most successful investors in history. His journey began not with a massive fortune, but with a simple, disciplined approach that he has followed for his entire life. He turned a small sum of money into a multi-billion-dollar empire, and not through flashy, high-risk bets, but through a calm, consistent, deeply thoughtful strategy. His success is so legendary that investors all over the world hang on his every word, hoping to uncover the secret to his incredible track record of building wealth. But what if I told you the secret to his success isn't a complex formula hidden in a vault? What if the key to his investing genius is far more accessible, rooted in common sense, and a specific set of behaviors? That's the idea in LouAnn Lofton's book, Warren Buffett Invests Like a Girl, and why you should too. The title grabs attention. It's provocative and meant to make you think. It's not about gender. It's about a powerful set of traits that lead to better investment results over the long run. Traits research shows are often more common in women investors. So what does it mean to invest like a girl? Embrace patience, discipline, and a focus on the long term. Be less prone to overconfidence and more aware of risk. Do your homework, stay calm when others panic, and resist the urge to chase the latest hot trend. These principles have guided Warren Buffett his entire career. While finance often celebrates aggressive, fast-paced, high-risk maneuvers, Buffett's playbook is the opposite. He favors a slow and steady approach that prioritizes preserving capital and lets compounding work its magic over many years, not a few frantic months. In this video, we're going to unpack this powerful concept. We'll explore why these so-called female traits are the bedrock of successful investing for everyone. We will break down Lofton's core message and show how Buffett's strategies align with this behavioral framework. The goal isn't just theory, it's a practical, actionable masterclass you can apply to your financial journey. By the end, you'll see you don't need a finance degree or a secret algorithm to build wealth. You need the right mindset, a healthy dose of patience, and the discipline to stick to a simple, proven plan. Let's dive deeper into the provocative phrase at the heart of this book. Invest like a girl. What does LouAnn Lofton really mean by this? The idea is based on extensive research into behavioral finance, which studies how psychology influences our financial decisions. Studies show behavioral patterns more common among women lead to superior returns over time. These aren't stereotypes, they are observable tendencies backed by data. For example, men tend to trade stocks about 45% more often than women. Frequent trading, often driven by overconfidence, can lead to higher transaction costs and lower net returns. Women, in contrast, tend to adopt a buy and hold strategy, which aligns with Buffett's philosophy. This book isn't about creating a divide between genders. Instead, it uses this observation as a lens to examine the behaviors that made Warren Buffett a legend. Buffett's success is not due to innate male aggression or a high-risk appetite. It's due to traits often associated with female investors: a more thoughtful approach to risk, a tendency to be less overconfident, a greater sense of discipline, an incredible amount of patience. Buffett famously said, "Our favorite holding period is forever." This long-term perspective opposes frantic short-term trading that hurts the average investor. The book's goal and the goal of this video is to reframe what it means to be a good investor. The financial world often glorifies the image of a lone wolf, a risk-taker who makes bold, daring moves to score quick profits. But the evidence and Buffett's career tell a different story. Success is found in quiet consistency, not loud speculation. Thoughtful instead of impulsive, humble instead of overconfident. By labeling these winning behaviors as investing like a girl, Lofton challenges our assumptions. Recognize that lasting wealth is built with prudence, not panic. It's a powerful message encouraging a more measured approach. Throughout this masterclass, we'll see example after example of Buffett's famous investment decisions guided by these principles. We will look at how he avoids the emotional trap of fear and the trap of greed. We'll examine his meticulous process for understanding a business before investing a single dollar. We'll explore his unwavering discipline to stick with his strategy even when markets go wild. This isn't just a clever title, it's an insight into the psychology of success. Calmer, more deliberate, long-term oriented mindset. The true secret to winning the investment game. The psychology of successful investing. Why our emotions are often our worst enemies. Fear, greed. Animated examples will show a panicking investor who sells at the bottom versus a calm investor who stays the course or even buys more. Next, Buffett's approach to risk. Understand the difference between risk and volatility. Simple charts will compare risky speculative strategies with steady long-term approaches. Then, practical rules for staying the course. We'll unpack Buffett's circle of competence. Why he only invests in businesses he can understand, plus a visual to help you define your own circle. We'll cover the power of patience and long-term thinking, with timeline animations that show compounding turning small regular investments into a substantial nest egg. We'll contrast that with the futility of short-term trading and why market timing usually fails. The focus, building disciplined habits that serve you for decades. Finally, principles of quality, simplicity, and valuation. Why boring, predictable businesses often win and why Buffett prefers them to flashy tech stocks. We'll demystify valuation, show how to find a fair price, and explain the importance of a margin of safety. We'll finish with a concise summary of key takeaways for every investor. By the end, you'll have a complete Buffett-inspired playbook and the behaviors that drive his success. Let's get started. Now that we've set the stage, let's begin our deep dive into the core principles of this powerful book. We start with the very foundation of the argument, defining what it truly means to invest like a girl. This phrase, as used by LouAnn Lofton, isn't about gender. It's a powerful shorthand for a specific investment mindset. It represents a framework for making decisions based on prudence, patience, and a deep understanding of one's own limitations. This mindset stands in stark contrast to the aggressive, high turnover, and often overconfident approach that is so frequently glamorized in financial media. It's about recognizing that successful investing is less about making brilliant, lightning-fast predictions and more about demonstrating consistently good behavior over very long periods. This framework is built upon a collection of behavioral traits that, according to numerous studies, are statistically more prevalent among female investors. These are not biological imperatives but observable patterns in decision-making. These traits include a lower propensity for overconfidence, which leads to less frequent trading, and lower costs. They include a more diligent approach to research, ensuring a thorough understanding before committing capital. Furthermore, this mindset involves a natural inclination towards long-term planning rather than seeking short-term thrills. It's a patient, nurturing approach akin to planting a tree and tending to it for years rather than trying to guess which lottery ticket will win tomorrow. Warren Buffett's entire career is a testament to the power of this exact mindset. The book argues that by adopting this girl mindset, any investor can build a stronger foundation for success. It's about shifting your focus from the market's daily noise to the fundamental quality of the assets you own. It means you stop asking what stock will go up next week and start asking, is this a wonderful business that I would be happy to own for the next decade? This change in perspective is profound. It transforms investing from a stressful game of speculation into a calm, deliberate process of accumulating ownership in great companies. It's a philosophy that empowers you to act like a business owner, not a gambler, which is precisely how Buffett sees himself. Ultimately, this framework is about emotional control. It acknowledges that human beings are not perfectly rational, calculating machines. We are driven by powerful emotions that can lead us to make disastrous financial decisions. The girl mindset, as described in the book, is one that naturally builds defenses against these emotional impulses. It encourages a healthy skepticism of hype, a disciplined adherence to a preset plan, and the humility to admit what you don't know. These behaviors act as a psychological shield, protecting your portfolio from your own worst instincts. This is the starting point for everything else we will discuss. Mastering your own behavior is the first and most critical step on the path to becoming a successful investor. Warren Buffett often called the Oracle of Omaha, is one of the most successful investors in history. But his success isn't built on complex algorithms or risky, high-flying bets. Instead, he follows a simple, profound philosophy. He buys wonderful businesses at fair prices. How does he find these wonderful businesses? He reads specifically their financial statements, income statement, balance sheet, cash flow statement. These documents are the storybooks of a company, where it's been, how it's managed, and where it might be going. They are the scrolls that reveal the secrets of a company's health and strength. The book by Mary Buffett and David Clark acts as our guide, a Rosetta Stone for deciphering these financial scrolls the way Buffett does. Not to become an accountant, but to become a business analyst. Identify companies with a durable competitive advantage, a powerful, lasting edge that protects them from competitors.
This video will walk you through, chapter by chapter, translating intimidating finance into clear, practical steps, profit power, prudent debt, and real cash generation.
We'll define the durable competitive advantage, the moat. Then dissect the income statement, gross margins, operating costs, consistent earnings. Next, the balance sheet, what a company owns, what it owes, and retained earnings. Finally, the cash flow statement, the ultimate test of profitability, Bachubanki, and we tie it all together with a practical checklist. Language simple, examples clear, pace steady. Learn to ask the questions Buffett asks to find exceptional businesses that last. The cornerstone of Warren Buffett's philosophy is the search for a company with a durable competitive advantage. He famously uses the metaphor of a castle and its moat. The business is the castle, a generator of economic wealth. The competitive advantage is the moat, the protective barrier. It keeps invaders, competitors at bay. A wider, more formidable moat makes future profits more secure. This isn't about a temporary edge or a short-term trend. It's a structural advantage built to last for years, even decades, allowing high returns on capital. That durability translates into superior economics. One of the most powerful moats is a strong brand, a brand that commands a premium and loyal customers, exhibits pricing power. Another moat is a low-cost advantage, producing more cheaply to undercut competitors or enjoy higher margins. Switching costs create stickiness, is too inconvenient or expensive for customers to move. Intangible assets like patents or licenses grant exclusivity. Buffett's long-term focus ties directly to moats. He doesn't want one great year. He wants businesses that can predictably generate strong earnings for the next 10, 20, even 30 years. The moat provides that predictability. Pricing power, raising prices to offset inflation without losing significant business, is a critical sign of superiority. When a business doesn't compete solely on price, you've likely found a moat.
The first question for any business: what is its moat? Is it wide and deep? And is it getting wider or shrinking?
The numbers are the footprints of the moat. High profit margins, consistent earnings, low debt, and strong cash flow. Let's unroll the first financial scroll, the income statement. The income statement shows performance over a period, a quarter, or a year. Think of it as a video of operations from sales to final profit. The story begins at the top, revenue or sales. Buffett wants a consistent upward revenue trend. Erratic or declining revenue is a red flag. From revenue, subtract cost of goods sold, the direct cost to produce, raw materials, and direct labor. Gross profit is core product profit before other expenses. Strong brands command high prices, often yielding high gross profit. Key metric: gross profit margin. Gross profit divided by revenue times 100%. Buffett seeks consistently high gross margins. A moat signal: constant price fights squeeze margins. Unique offerings and Dominant brands can sustain high margins. Software may show 80% margins. Groceries downs 20%. Compare, then prioritize consistency over time. Pull 10 years. Is the margin stable and high or volatile and trending down? Next, operating expenses. SG&A, like marketing, sales salaries, HQ costs. R&D can be vital but expensive. Consistency and efficiency matter. Gross profit minus operating expenses gives operating profit. Operating margin should be high and stable. After operating profit, subtract interest. Buffett prefers little to no debt. If the income statement is a video, the balance sheet is a snapshot. It shows what a company owns and owes at a point in time, and the two sides must balance. Fundamental equation: assets equal liabilities plus shareholder equity. Assets are listed by liquidity, first current asset, cash and cash equivalents, financial strength and flexibility. Cash helps survive tough times, make strategic acquisitions, and return money to owners without borrowing. Watch receivables. If they grow faster than revenue, trouble collecting or loose credit terms may be inflating sales. Inventory must be efficient. Too much ties up cash and risks obsolescence, especially in tech and fashion. Buffett favors quick turnover or models needing a little inventory. Liabilities include current obligations and long-term debt. The latter is critical to monitor. Great businesses fund themselves primarily from operations. Heavy debt is a fixed cost drain and raises bankruptcy risk. If debt could be paid off in a few years of earnings strength, if it takes many years, risk. Shareholder equity is owner's stake. Retained earnings are cumulative net earnings minus dividends. But powers compounding. Consistently rising retained earnings shows profitability and wise reinvestment. Stewardship of owners' capital.
Focus on manageable debt and growing retained earnings. Those are durable signs the business itself is becoming more valuable.
Retained earnings growth beats daily stock price noise. Next, return on equity and how debt can distort it. Having examined the income statement and balance sheet, we can connect them for deeper insight. Return on equity (ROE) measures profit per dollar of shareholder equity. ROE equals net earnings divided by shareholder equity. High consistent ROE is a money compounding machine. Buffett prefers ROE ideally above 15% year after year. Long-term high ROE often reflects a durable competitive advantage. Calculate a decade. Is it high and stable or low, volatile or declining? Caveat: debt can artificially inflate ROE by shrinking equity. A company can raise assets using debt. If profits rise but equity stays small, ROE looks bigger. Example: 25% ROE financed by a mountain of debt is far riskier. Compare 17% ROE with almost no debt. Higher quality.
Always analyze ROE alongside debt. The ideal Buffett-style business posts high, consistent ROE with little to no long-term debt.
That combination is the financial fingerprint of a truly wonderful business. It shows returns come from intrinsic operational strength and the company's moat. Not risky leverage. Next up, the statement that tracks the lifeblood cash. The cash flow statement is more direct than earnings. It tracks actual cash moving in and out. 3 sections: cash flow from operations, from investing, and from financing. For Buffett, the most important is operations, the cash generated by normal business activity. It starts with net income, then adjusts for non-cash items like depreciation and changes in working capital. Over time, healthy CFO should track net earnings fairly closely. Persistent gap, high profits, weak cash is a major red flag. Phantom profits. Capital expenditures, spending on property, plant, and equipment. Some models are capital intensive, others like consulting or strong brands are capital light. Free cash flow equals operating cash flow minus capex. The surplus cash after necessary investment. Free cash can pay dividends, buy back shares, pay down debt, or fund acquisitions.
Buffett obsesses over free cash flow because it represents real, spendable profit for the owner.
A history of strong and growing free cash flow is the ultimate sign of a healthy, wealth-generating business. With the three statements decoded, let's synthesize them into a disciplined checklist to find Buffett-style businesses. It's time to synthesize our findings into a coherent analysis. Use the numbers as evidence to support a qualitative judgment about competitive advantage. This is not a rigid formula, it's a disciplined framework for long-term success. 1. Does the company have a durable competitive advantage? Strong brand, low-cost producer, or high switching costs? 2. Income statement consistency, steady revenue, high and stable gross and operating margins. 3. Earnings history, predictable growth over a decade, not one-time windfalls. 4. Balance sheet, manageable debt. Could the long-term debt be paid off in 4 to 5 years of current net earnings? 5. ROE, high and stable from a great business, not inflated by leverage. 6. Cash flow, strong operating cash and abundant growing free cash flow. This process forces you to think like a business owner, not a speculator. Evaluate the economic engine, not just its fluctuating price. Strong margins, consistent earnings, low debt, high returns on equity, and strong free cash flow. These signal wide moats.
Durable competitive advantages matter most. Consistent earnings beat flashy growth, and cash flow is king.
Businesses with moats withstand storms, fend off competitors, and compound intrinsic value. This is the core lesson from Buffett's book, A Timeless Path to Intelligent Investing.
Accounting is the language of business. That is a simple truth. If you want to understand a company, you must speak its language. You would not invest in a foreign country without understanding its culture or its laws. Likewise, you should not invest in a business without understanding its financial statements. These documents are the grammar and vocabulary of commerce. Income statement, balance sheet, cash flow statement. They tell the complete story of a company's performance, its strengths and its weaknesses. For an investor like Warren Buffett, these are narratives, not dry numbers. Many investors shy away from financial statements. They find them intimidating. This is a mistake. The core ideas are not difficult to grasp. You do not need to be a CPA to read them effectively. You just need to know what to look for. This guide will break down Buffett's method into simple, manageable steps. The income statement is like a movie of a company's financial performance over a specific period, such as a quarter or a year. It starts at the top with total sales and step by step subtracts all the costs of doing business until it arrives at the final number, net income, or the bottom line. This statement answers the most basic question: did the company make a profit? Buffett begins his analysis here, but he looks for more than just a positive number at the end. He wants the quality and consistency of those earnings: revenue, cost of goods sold, gross profit, gross margin, and gross profit divided by revenue. A high and stable gross margin suggests a strong competitive advantage. It shows pricing power. Operating expenses, marketing, administrative salaries, research and development. Operating income, gross profit minus operating expenses. A cleaner number than net income because it excludes interest and taxes. Non-operating items, interest, taxes, net income, the famous bottom line. But it does not always tell the whole story. Buffett is inherently skeptical of reported earnings.
Accounting rules allow for management discretion. A company might recognize revenue before cash is received or change an estimate to boost profits for a quarter. If the income statement is a movie, the balance sheet is a single photograph. It provides a snapshot of a company's financial position at a single point in time. It is governed by a fundamental equation: assets, liabilities, equity. Everything a company owns was paid for by borrowing or owners. Assets are what the company owns, listed by liquidity, cash and cash equivalents, accounts receivable, inventory, property, plant and equipment. Buffett pays close attention to asset quality. A large and growing pile of cash is wonderful. A large and growing pile of inventory can be a red flag. He is wary of large goodwill. It can evaporate if an acquisition fails. On the other side are liabilities and equity. Liabilities are what the company owes: accounts payable, short-term debt, long-term debt. Buffett strongly dislikes excessive debt. Debt makes a business fragile. Interest must be paid in good times and bad. He looks for little to no debt compared to equity. The debt to equity ratio is a key metric. Shareholders' equity or book value is assets minus liability, the owner's residual. Buffett wants to see it grow steadily through retained earnings. A strong balance sheet is non-negotiable for Buffett, the foundation for great businesses. While the income statement reports profits, the cash flow statement tracks the actual cash moving in and out. This distinction is crucial. Buffett famously said, "Cash is a fact, profit is an opinion." The cash flow statement cuts through estimates and shows reality. It is broken into three main activities: operations, investing, financing. The first and most important section is cash flow from operations. It starts with net income and adjusts for non-cash expenses and working capital changes. In a healthy company, operating cash flow is positive and tracks net income over time. If profits persist but operating cash is weak, it's a massive red flag. Cash flow from investing, typically negative as firms buy as assets, capital expenditures, includes proceeds from asset sales and acquisitions or divestitures. Financing shows how capital is raised and returned. Debt stock in, repayments, dividends, buybacks out. Mature, healthy firms often financing cash acquiring cash flow. A company consistently borrowing or issuing shares to fund operations signals weakness. Analyzing all three sections together reveals the lifeblood of the business. Once you grasp the statements, you can analyze performance. One of Buffett's favorite metrics is return on equity or ROE. RO measures how effectively shareholders' money generates profits. An ROE of 20% means 20 cents of profit per dollar of equity. Buffett seeks high ROE consistently over a decade or more. Often above 15%, sustained ROE suggests a durable competitive advantage, a moat, strong brand, patents, or a low-cost structure. High ROE can be misleading. More debt reduces equity, the denominator, making ROE look bigger without real profit improvement. A highly leveraged company is fragile and vulnerable to downturns. Always check ROE alongside debt levels. Look for high ROE achieved with little or no debt. When debt is low and ROE is consistently high, you may have found the kind of wonderful business Buffett loves to own. While net income and ROE are useful, Buffett prefers owner earnings, a clearer view of true cash generating power. Reported earnings can be distorted by non-cash charges, notably depreciation and amortization. Owner earnings seeks the cash truly available to distribute or to reinvest for growth. Start with net income. Add back non-cash charges like depreciation and amortization. Subtract maintenance capital expenditures. Maintenance CapEx keeps operations running. repairs, replacements is key, distinct from guide A from growth spending it's growth spending. Owner earnings equals net income plus depreciation and amortization minus maintenance capex. Firms don't report maintenance capex explicitly. In practice, analyze long-term total capex to estimate maintenance needs, especially for stable businesses. Owner earnings reveal surplus cash. High reported profit that must be fully reinvested creates little value. Buffett wants gushers, far more cash produced than consumed. These firms can pay dividends, buy back stock, and make smart acquisitions, all without taking on debt. Calculating owner earnings is key to finding them. Ratios are the investor's toolkit. They turn raw numbers into comparable metrics. Buffett avoids dozens of obscure ratios and focuses on a handful that reveal economics. The priority is a durable competitive advantage, a moat. Moats protect profits and sustain high returns on capital. First, margins. Consistently high gross margin signals pricing power. High stable operating margin signals efficiency. Operating margin halves operating income, revenue. Thin or pressured margins often mean fierce competition. Debt to equity is a quick leverage check. Buffett prefers below 0.5. Interest coverage above 5 shows a comfortable cushion. ROE and ROIC are master profitability metrics. ROIC includes debt and shows how well all capital is used. Durable moats produce high margins, low leverage, and sustained high returns on capital. Common moats, brand, low cost, and network effects. Financials can also flash warning signs. Learn to spot red flags with healthy skepticism. Management is incentivized to present the best light, sometimes stretching rules. A growing divergence between net income and operating cash flow is a major red flag. It can signal aggressive revenue recognition or customers not paying. Watch for rapid AR growth relative to sales. Frequent one-time charges, constant restructurings, and large write-offs often indicate weak management or tough industries. Watch debt to equity. Is it climbing? Is financing cash flow positive because the firm borrows to cover losses or capex? That's cash consumptive. When weak cash flow, strange accounting, and rising debt appear together, it is often best to step aside, no matter how good the story sounds. Mastering financial statements isn't about quick math in 10 minutes. It's about a mental framework for judging business quality. Buffett's approach is cohesive. Each statement informs the others to build a complete picture. First, take a long-term view. Gather 5 to 10 years of data. Look at the income statement. Is revenue growing? Are gross and operating margins high and stable? Then the balance sheet. Is debt low and equity growing? Critically compare net income to operating cash flow. Estimate owner earnings by subtracting maintenance capex. Does the business gush cash? Finally, calculate ROE and ROIC. Are they high with low leverage? Do the numbers show a durable moat? If yes, you may have found a wonderful business.